Hope you had a good bank holiday weekend. Obviously just now moving into May. April is done and dusted, and we're just going to have a quick look back at some of the asset performance through that month. I'm just looking at the usual charts to begin with, though. I've got all these charts set to a daily setting, so we're just going to have a little step back and look at the sort of medium-term picture this morning. As things stand here, I mean, markets have opened reasonably flat, I would say. Looking at these daily charts, most of these markets are tracking around the price points that they were trading either yesterday in a very light volume bank holiday session, or indeed the price points trading back on Friday. So we'll come and have a look and zoom in on a bit more shorter term price action in a minute. But look, let's just look back and have a look at April. So this is just something Deutsche Bank do actually end of each month. In the morning read, they put together a chart where they select 40 or 50, I think it's 50 different assets, and they shove it all on one chart, and we can kind of get an overall view of how markets moved. So this is the chart for April. This is in local currency terms, so this is stripping out any exchange rate movement. And what we've got is Greece definitely winning the race. So the Athens Stock Exchange up 7%. A lot of this is because of the progress being made towards further EU bailout funding as the fiscal adjustment program moves closer to being signed off. Of course, July is the key month for Greece. They've got an absolute mountain of a set of redemption payments to pay back in July. So as it stands, things look like they're moving towards stuff getting done, and Europe continuing to pay for these redemptions, and Greece continues to cling on with its fingernails. But Greek assets certainly benefiting from good progress. We then got a bit of a mixed bag. I mean, it's mostly equity dominated on the left-hand side, with also, of course, a couple of currencies in here. So sterling being the second best off the back of the snap general election. We've got the European banks doing very well. We've got the Spanish index. We've got the euro doing well. And you can kind of see the rest. Gold's in here. It's interesting. Gold's up 2%. If you track across to the very far right-hand side, check out silver. Silver's the worst performing asset of the whole lot, down 6%, and yet gold is up 2%. Quite an unusually large divergence there between those two. I mean, silver does have slightly different kind of price drivers than gold. There's a lot of industrial usage for silver, but still quite unusual to see a divergence like that. Other stuff on the right hand side then, of course, oil had a bad month, and we'll look at that. Certainly as we went into the end of last week, more Libyan supply coming on the market, which was just helping with that downside trajectory. We've had a couple of bad weeks for the price of crude as it dropped back below $50. We're edging closer to June, of course, which is the most important month for the price of oil, I would say, as we track through the summer, and that's because we've got the OPEC meeting in June, and we want to see if they're going to extend their production cuts. So anyway, it's always good to have a little step back and look at how assets have performed. The other thing of note over the weekend is this. Donald Trump has managed to survive 100 days in office. This is always an important kind of landmark for any new president. That's because when they're on the campaign trail trying to win an election, they're always promising, I'm going to do this and 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 this within my first 100 days in office. Okay, that first 100 days is a key time point. That's enough time for them to get in the seat and then, start to deliver on promises. So it's been an entirely unique first 100 days. We've been talking about this to death for the last 100 days, in fact. But what I thought I'd do is have a look. Deutsche have done quite a good sort of snapshot overview here. If you have a look at this table, this is looking at the campaign proposals on the left-hand side. What did Trump promise? And then on the right-hand side, well, what's actually happened? Has he actually delivered on any of this stuff? Certainly the top end of the table, you've got all the, what should be, on the face of it, well, certainly sentiment positive policies, populist policies. These, whether they will deliver, well, whether he delivers them in the first place is one thing, but should he deliver them, whether they deliver on the promised acceleration in GDP, the return to a deregulated banking system, a return to jobs for middle Americans, whether that happens or not, of course, is still to be determined. But I mean, most of this stuff at the top, of course, he's got nowhere with. So there's absolutely nothing on the infrastructure spending, of course, and now actually we're not expecting that until next year at the earliest. This was supposed to deliver a boost to economic growth. So limited new information on that first one. On the tax side, well, we got what was supposed to be, huge detail on this last week, and of course remove the word huge and replace with almost no detail. So he literally wrote one page on A4 and handed it out. There's your new tax reform. So as it stands, this stuff is miles off getting through, or even getting to Congress, never mind getting through it. But of course he's still talking a big game. I mean, that's certainly something you can't take away from Trump. He talks a phenomenal game, and he carries on doing that. So 15% on corporation tax is still what he's pushing for. So, but of course, none of this has been delivered. Tax plan announcement singled for this week. Sorry, that was for last week. All right. So we've had vague detail, nothing more. On the regulatory side, well, there is an update on that actually over the weekend. I mean, during the campaign, he'd promised to repeal Dodd-Frank, which is half the reason why US banks have rallied to new all-time highs. Over the weekend, he has made a comment on that, and what he said over the weekend was he's actively considering a breakup of Wall Street banks, and specifically calling for a 21st century version of the 1933 Glass-Steagall law. Okay, so this is the comment from Trump over the weekend, which again seems like it's a complete reversal and U-turn and a tangent on what he was been talking about to date. Actually, ironically, banks share prices sold off to start with, but then rallied. And yesterday, JP Morgan closed up 1.1%, Morgan Stanley up 0.88%, Bank of America up over 1%. So actually, banks taking that in their stride. But of course, nothing's happened on that, with regards to it actually getting anywhere nearer to becoming reality. If we look down then on the Fed, well, he's now said he likes Yellen. He's a fan of low interest rates. So again, a massive U-turn on what he was talking about his campaign. Of course, he hasn't. He said he's open for Yellen to continue in the job. There are 3 current vacant seats though. So the vice chair of supervision needs to be filled, and of course the focus on the chair herself, but at the moment maybe Yellen's going to be the person. Right, let's get down to the second half of this table, because this is where he's actually tried to do stuff. Some of it he's done and he's pulled it off as promised. Some of it he's been blocked by of course the Supreme Court, because what he's tried to do was illegal. So certainly on being tough on China, well, he's now seems like he's China's best friend. Introducing tariffs, well, he hasn't introduced any tariffs. He has tried to renegotiate, well, he's threatened to renegotiate NAFTA, and now he thinks actually NAFTA's not bad, and maybe actually we should renegotiate it, but renegotiate it in a way that's good for not only America, but that's good for Canada and good for Mexico as well. He has rejected TPP, that's the Trans-Pacific Agreement, but that was already clogged up in Congress anyway. With regards to his foreign policy, well, obviously there's been quite dramatic moves here. Firstly, on his isolationist stance, of course, that got held up in the Supreme Court. That's his ban on immigration from 7 Muslim countries. His swing towards Russia, well, certainly his actions in Syria seem to have swung away from Russia. So that's certainly something that's interesting. And obviously his bombing of Syria, then bombing, dropping the world's biggest ever non-nuclear bomb in Afghanistan. Of course, these are major developments on the foreign policy side and goes quite a lot against what he was campaigning for, and that was for the US to no longer be the world's police force. He's fed up of the US paying to protect others. You know, this was his mantra in the campaign, and of course, again, he seems to have entirely contradicted himself. Tough stance on immigration. Well, he's trying to build the wall, but there isn't enough money, and so it looks like the wall, and obviously they're most likely going to negotiate a 1.2 trillion budget this week. Of course, we've been living in this slight uncertainty that maybe the US government's going to shut down again like it did back in 2013 because of an inability to agree on a budget, but looks like we're going to get that budget agreement. Part of that is Trump backtracking and maybe delaying his wall. Repealing Obamacare, well, that failed. That was his first test of trying to get any kind of policy through Congress, and failed. So this is why we're a little bit now skeptical about his ability to get any of these policies through, and obviously most importantly his tax reform. So, you know, I'd say most of the stuff on this list, either no progress or failure or U-turns on messages he was delivering before he actually won. The things he's actually done that he said he would is the wall, although he's signed an executive order for that. And actually, here's quite an interesting couple of charts. Here, with regards to his approval rating, if we compare him to Obama, this is from The Economist here, this is Obama's first 100 days in office. Of course, Obama came in on a huge wave of optimism, new dawn, and huge his approval rating was kind of record ever levels. Trump started, his approval rating was 0 and has been negative for the entire time. He's off the bottom, around about 67, 68 days is where his approval rating for now troughed. But of course it's still in negative territory. Here's quite an interesting chart. So here are the number of executive orders signed off in the first 100 days. So actually Obama got going straight out the gate, delivered a huge portion of executive orders in the first 2 weeks. Then it kind of flattened off and it calmed down. Trump's kind of tried to go in fast, and it just hasn't stopped. I mean, he's had flat lines where he's been distracted, but ultimately the number of executive orders is still definitely on the up here. So he's trying to do stuff. In terms of markets, I mean, what I would say, of course, obviously you've got markets still being pretty immune to Trump, and you've still got equities tracking up on, up and near all-time highs, of course. Well, what happened yesterday, which was of note, was the VIX. This is a chart of the VIX, or as others call it, the fear gauge. It's looking at volumes on call options and put options for the S&P 500. Whenever this is high, that means we're panicking. Whenever it's low, this means we're not panicking, we're very calm. That's investor sentiment. And you can see these huge spikes. This is looking over the last decade, I should have said. So you can see the huge spike up to 90 here as Lehman Brothers collapsed and we had the big dramatic fallout. We then got the various surges higher. Eurozone debt crisis in 2010, Eurozone debt crisis in 2011. Things calmed down. Then we had the China risk blowing up in 2015 and various stabs higher. It has got a little bit more active over the last couple of years, and that's mainly because in October 2014 the Fed stopped stimulating, so the Fed's safety net's been removed. But the most important thing to note was yesterday the VIX closed below 10, and no, that is inaccurate, sorry, it closed at 10.11. It reached a low of 9.9. The point about that, and the stat in the read this morning was quite a good one. This VIX goes back to 1990, so we've been measuring this volatility index. This fear gauge has been in existence since 1990, which makes it 6,871 trading days that this index has been tradable and trackable. 6,871, and the levels we saw last night as we dipped below 10 and hit 9.9, only 14 days have we seen a lower print in the VIX in its history. So in the last 27 years, the VIX has only traded below last night's level on 14 occasions, which puts us right at the bang bottom of this index. And if we flick to the charts just quickly, you know, this is definitely, you know, well, there's two schools of thought here. There's a lot of people sat scratching their heads thinking, I mean, what are you kidding? You know, we've got still a lot of political risk. Okay, Macron's going to win the election this weekend. The polling, which was accurate in round one, is still showing Macron with a nice healthy 20% lead. So all right, French political risk certainly looks like it's dealt with. We do have that final televised debate, Macron versus Le Pen on Wednesday, but it certainly looks, unless we have something extraordinary occur this week, then, and what might those be? I mean, to be honest, I hate to say it, but a terrorist attack would certainly play into the hands of Le Pen, God forbid. If Macron does something ridiculously stupid, which is obviously unlikely, then maybe if French voters decide, don't need to bother, Macron's got it in the bag, don't need to bother to show up, maybe there's an outside. The lower the turnout rate, the better it is for Le Pen. But look, this is clutching at straws. Macron is most likely going to do the business. But of course we've got Brexit risk still, and obviously key developments on that over the weekend. It looks like Juncker and his team have been leaking the details, the behind closed doors meeting that Juncker had at 10 Downing Street last week. The official statements following that from both sides were that talks were constructive, but now it looks like the EU have, well, for whatever tactical reason, have decided to spill the beans, and you got headlines like Juncker saying there's less than a 50% chance of a deal being done, and comments like that suggesting that actually, and rumours there were arguments and shouting during the meeting, Juncker even complaining about the quality of the food, all this kind of nonsense. To be honest, you shouldn't have expected anything else. This is certainly tactical. We are now, the negotiations have started. All right, this is very much tactical play from the EU side with regards to applying pressure, and it's all part of the game. You should expect nothing less. And as you can see, markets aren't too bothered. If we just bring in cable here, cable's still at the top off that big spike following the snap election announcement. And here we've tracked higher again last week, made this new high, almost hit the 130 handle. New highs for the year, of course. We've drifted a little bit lower Friday, slightly lower again today, but sorry, a little lower Monday, that's yesterday, slightly lower again today. But we're still right up here. It's not like sterling has panicked here off the back of these EU leaks suggesting that this negotiation ahead of us is going to be harder than we thought. I don't think anybody's got any fantasy about how difficult this is going to be. Let me just adjust some of these lines. So anyway, pretty quiet, but certainly sterling slightly on the back foot, back below the 129 handle. Let's check gold, because obviously the VIX closing at almost a record low. And gold slid yesterday and moving down below levels we traded at last week, and so here we are in gold trading down around the 1250 handle, and this was taking us back to levels we haven't seen since the 11th of April. We've dropped back below, which kind of gave rough support last week. We had these kind of two support levels, the Feb high, and we had the high point at the end of March, and this is just given way yesterday. So it kind of opens the door here. Technically, you might say 1240 area, which was the end of March low, might be next target. If kind of conditions remain, if sentiment remains positive, we may well see this continue to drift back slightly. But let's look at a couple of other things. We've obviously talked about Trump and 100 days. We've had a quick review of asset price movement in April. So a couple of other things to talk about. Well, we spoke about the VIX. Let's just bring you up to date on the data that we had yesterday, because the US were open. We had some data, and this is tier 1 stuff. It's the Manufacturing data, the ISM manufacturing numbers came in a little bit disappointing, 54.8. We had quite sharp drops in the employment component. We had a drop in the new orders component as well, so a little bit disappointing, but as you can see, it's still pretty punchy. Anything above 54, anything in the mid 50s is very healthy. If you look back over the last 10 years, then 54, well, let's just call it 55, rounded up. The actual number was 54.8. 55 is certainly top end of the range that we've seen for sure, so it's still very healthy. It's just that we've dropped quite a lot off that very high print we had over the last couple of months, and we now got a downward trajectory. So we're always looking at trend, of course, and is this the beginnings of a deterioration in the US data set? We had GDP data, of course, from the US last week that disappointed. On that, what was of interest, and actually let me just quickly show you that chart. If we look at US GDP, came in at plus 0.7, and lowest reading, well, actually, let's go back. Lowest reading since, 2014. That's quarter one 2014, very heavily weather-affected quarter that saw contraction. So apart from that, that's the lowest reading we've had in a few years, of course. So obviously disappointing, but the Atlanta Fed GDP tracker nailed this. What the Fed that didn't nail it were the New York Fed, who were predicting something above 2%. So these two Fed kind of trackers were divergent for quarter one, and the Atlanta Fed has won. Now, what's interesting about that is, and if we just refresh this, what's interesting is the Atlanta Fed are currently tracking, let me just get this right, their quarter two GDP is currently at 4.3%. So what the Atlanta Fed are predicting are a slow quarter one and a very strong rebound quarter two. They're predicting the strongest quarter of growth since 2014. Okay, so just bear that in mind. Yes, a little bit weak here, but things are looking better for quarter two if you're to believe the Atlanta Fed. Let's look at the week ahead then, and we'll finish by just looking at some of those other charts. But just on the week ahead, it's a very busy week. It's the first week of the month as usual. We just look at today's calendar first. We're getting manufacturing PMI prints from across Europe. These are the final readings. We've just had Germany's come in line with expected, 58.2, very healthy. The French number in line with expectation at 55.1. Italy, slight beat, 56.2. Switzerland to come in slightly worse, 57.4. Spain, 54.5, slightly better. In the main, these are pretty healthy. Do remember, for most of these European numbers, we get a preliminary reading kind of in the third week of the month. So in the third week of April, we got readings on this, and we're just getting updates, and these updates are normally not far off what was expected. So these PMI numbers from Europe are now in. We're expecting the Eurozone as a whole. That's going to be delivered now. In fact, we're going to get that in 5 seconds time. I'll announce as it comes in here. 56.8 is what is expected, which is obviously an increase on that previous 56.7.
That's below the expected
56.7 in, so pretty much in line with expectation. Just to kind of put that into context, where does that put this? Europe have had a great start to 2017, I would say, from an economic data point of view. And if we just go down and have a look at that PMI number, it kind of sums it up nicely. Look at this. This is such a positive trend for Europe, and for the first time in years, you'd say half a decade and more. In fact, you could even go as far as to say for the first time in a decade, economic measurements in Europe are really starting to look better for once. If you look back over the last 5 years, this is the picture. If you look back over the last 10 years, this is the picture. So best readings here since 2010, and they were only that high because we were bouncing off the collapse we had in 2009. So very strong here, and the only question is it sustainable? And we'll see as we track through the summer. So that's data so far. All the European stuff's in. We're going to get UK manufacturing numbers at 9:30 a.m. The UK data's definitely not been as good as Europe's. Obviously, inflationary pressures coming in. We've had stats like worst retail sales growth readings for 5 years. You know, you were starting to get some maybe Brexit wobbles. Maybe we're starting to get impacted by the negative effects of a cheap currency. So we'll see when the manufacturing numbers hit here. We're expecting 54. Other stuff, I mean, that's pretty much it for today in terms of interesting kind of top level data. We do have earnings continuing. So US earnings season does continue, and actually so far it's been very good. If you check out stats, actually, where was it? Let me go back to the economic calendar. Stats like of the earnings that we've had in so far. Here we go. So we've had 131 of the S&P 500 companies reporting already. 85% have beaten their EPS forecasts, which is a lot higher than the average. Normally you get an average of low 70% on the beat. So we're definitely we've had a good earnings season so far. Today we're going to get earnings from, well, the big guns in the UK. BP and Shell have already delivered their earnings, but also Apple are coming with results today. So I should say BP's today, Shell's Thursday, Facebook is tomorrow. So they're the kind of big numbers. Pfizer are also today. But Apple after the close, you know, always definitely one of the big earnings releases of the season, of course. So we'll check in on those and we'll give you a full update on that tomorrow morning. Okay. Well, on the kind of macro side this week, as I said, it's a busy week, always is, first week of the month. If I just quickly update you on what's coming at us and when. So let me just actually get this up on the screen so you can have a look at this whilst I'm talking about it. So obviously the highlight is going to be payrolls. So here we go. If I just make that a bit bigger, you can see here the highlight. So we've got tomorrow, we've got employment data from Germany. We've also got Europe PPI. We've got then the European March advanced reading for Q1 GDP. So that'll be the first print for the Eurozone as a whole. So this is coming tomorrow. We've got the ADP employment report coming at us on Wednesday. That's interesting because, of course, we had such a monster print last month, and let me just remind you on that because it's kind of crazy what happened. If I just show you, because we got of course non-farm payrolls coming on Friday. We had a really big print on ADP, best reading for years, and everyone's like, right, okay, game on, big payrolls number coming. Then we got the payrolls number 98. So it couldn't have been a worse lead indicator last month. Which means that when we get the ADP report tomorrow, it's probably going to have zero market effect because people have lost confidence in it being an accurate kind of measure or lead indicator for the much more important print, which is payrolls. So payrolls on Friday, of course, is key, and so we'll obviously be covering that in full. Before then, Thursday's full of the services and ISM non-manufacturing prints, which are all really important. Okay, so definitely a big week for data. Of course, shortened week because of the bank holiday. Earnings still ongoing. We've got the Macron-Le Pen televised debate on Wednesday. Of course, the election coming at the weekend. Trump's in action, as of course he always is. He's meeting the Palestinian president on Wednesday, which could be interesting. And we've got packs full of earnings still coming. All right, so definitely a busy week for news flow. I'm just going to finish by flicking back to the charts. So let's talk oil, and then we'll finish on equities. So oils, it'll be interesting to see what happens here this week. I mean, if we just check, let's have a look on the weekly chart because... And sorry, we've got, let me just get rid of, sorry Ant, if you're watching, I'm going to remove all your text. So, you know, we've had a pretty choppy start to this year for sure. We had the big sell-off that we at the start of March as we broke below $50. We had then the full reversal. Now it looks like we're tracking back to 47. 47's key. That's the very important price that everyone needs to be looking at. This is the kind of triple bottom we had back in March. If we zoom in on that daily time frame now, then you know it looks like we're heading towards there. It looks inevitable, I would say. Obviously, Libya helped last week as Libya brought back online their biggest oil field, so that's supply positive, price negative. But we'll see. Of course, I'll draw a line at 50 here, which is important. We had a go at breaking back above 50 last week. It failed. So we'll see how we go. The lower we're currently making a new high for the session as I speak, but it's all within this kind of range that we had from last week. So I say this week, technically, 48.19 was last week's low. Any break of that, and it's got to be inevitable that we trade and test $47. Of course, we'll have the inventory data coming on Thursday this week. Actually, it wasn't a US bank holiday, was it? So actually, scrap that. The inventory data from the US will be coming on Wednesday as usual, so we'll get API data tonight. But then it's listening out for any headline risk from OPEC, because we know what happened last time. The price was down around 48, 47. OPEC started talking it back up by saying that they are going to extend their cuts. So you've got to listen out for OPEC headline risk this week. As oil remains below 50, they don't want it below 50. Are they going to take their opportunity to talk it back higher? Let's finish with equities. So let's finish with the S&P. And you can see the DAX just to the left here. The DAX is bang in the middle of the range of the last 4 sessions. Just shy of the high that was set last week. And just to put that into perspective, looking, so I was going to talk S&P, but I'll just do DAX briefly, because you've got to understand we are above the high point that was set in 2015. We are new all-time highs, and so last week's level is an all-time high. Be aware of the April high at 12, well, let's just call it 12,400, which is roughly speaking the 2015 high. Okay, so that's key support if you're looking medium to longer term there. So keep an eye out for that price as we go through this week. But for the S&P, this is the daily chart here, and similar to the DAX, we're bang in the middle of the last 4 days range. For the S&P, we haven't made it up to make a new high last week. That high's the 1st of March top at 2,400. So keep an eye out for that. We got the top here from the 16th of March. We kind of just held things up last week. The key support, I'd say, for this week is either those low prints of the last few sessions, or it's 23.75, which is that obvious kind of standout top we had there on the 5th of April. Okay, but at the moment we're sideways, we're trapped in a tight little range, looking for developments to spur activity one way or the other. But the backdrop to everything is these markets remain incredibly resilient to negative news flow. There's this underlying seemingly unstoppable sentiment that wants to see risk assets continue to chug higher. So that's the theme that continues. All right, enjoy the week, guys, and have a good session. Thanks a lot.